Good afternoon, ladies and gentlemen. Welcome to our special episode of Market Gurus, where you get to meet the finest brains that there on Dalal Street, people and professionals who've made enough and more money during all kinds of market and industry cycles, who talk to us, who share their enthusiasm as well as abilities to make more money from current levels. Our guest for today is a special gentleman, Mr. Harsha Upadhyaya. He is the Chief Investment Officer at Kotak Mahindra Asset Management Company, a person with 28 years of experience in the markets. For the moment, he handles 7 schemes at Kotak Mahindra Asset Management Company, totaling more than 90,000 crore rupees, and has spent the last 12 years with Kotak. Before that, he was working with UTI Asset Management Company for 5 years, DSP Mutual Fund, and of course an earlier stint at UTI Asset Management as well. Namaste Harsha ji, good afternoon and a very warm welcome to you. How do you see sentiment on Dalal Street these days? We've had a trying 1 week or so after record highs. Is this the second half of 2024 a zone of consolidation, or do we see consistent record highs even from now?
Good afternoon, Shailendra. As far as markets are concerned, I think volatility is an inherent part of equity markets. So especially at higher valuation levels that we have been trading at, one should be expecting volatility to continue. If you look at medium to long-term growth trajectory of Indian corporates, clearly that is very, very strong. Our economic growth has also been moving quite nicely in the recent times and is expected to continue the similar kind of growth rates. So if you are an investor who is looking to participate in India equity story from a next 3-5 year kind of a perspective, then I think even the current market levels are reasonably good levels to look into. However, if you are a very short-term investor, I would say that investors investing into equity should not have a short-term horizon. But if you are a short-term investor, especially at high valuations of current times, one should be a little cautious about the sectors or the stocks which are trading at very high valuations and where earnings growth is kind of tapering down. I think that's something that one needs to keep in mind. However, if you're a long-term investor, I think it's a decent valuation to still get invested into the markets.
Okay, and I think Harsha ji, this equity fever and enthusiasm that we see in the market, which is very visible with rising systematic investment plans on a monthly basis, points to a vast majority of new investors coming into the market, aligning to this 3 to 5 year view. Let's see how it pans out for them. But let's just first discuss first quarter earnings, which have just got over 2 or 3 days back. What has been your assessment of corporate India? Where do you think over the next 6 months to 1 year will earnings rise, how should I say, strongly? And where do you think which parts of the industry have sort of slowed or at least given a sign of earnings having peaked?
Shailendra, if you look at the first quarter earnings season, it's been one of our muted expectations to begin with, and also the delivery has not been great. So more or less, I would say it's been a subdued quarter. After having seen very, very strong growth rates since COVID first wave, this is the first time where at the PAT level as well as the EBITDA level, things have not been as strong, which was anyways expected. So there is nothing that it has come out as an unexpected event. Because of the high base and because of how we have been moving over the last several quarters, it was expected to be a muted quarter, and it has panned out to be a similar one. Having said that, I would say this is probably one of the first quarters where we have seen an earnings downgrade from at least some segments. And to that extent, we were earlier looking at about 14% earnings growth for Nifty, and we are likely to now see about 12% for the year, financial year 25. So to that extent, this year we are likely to see slightly more moderate kind of earnings growth from Nifty as well as the rest of the market. And to that extent, I would say most of the sectors would come down in terms of the earnings growth levels as compared to previous few quarters and previous few years. In terms of your question, where do we see probably earnings kind of slowing down? Clearly, I think auto is one segment where we believe, given the fact that we have seen very, very strong earnings growth in the recent times, and going forward, there is unlikely to be any great improvement in margins. And also, we are seeing a little bit of inventory building up in certain segments of auto. We do believe that probably the earnings growth rate will be slightly weaker compared to what we have seen in the previous few quarters.
Okay. Harshaji, if you look at the monthly inflows that are coming into mutual fund equities, it's been a wonderful journey over the last 1 year or so, from somewhere like 12,000 crore rupees a month 15 months ago. We are now at 23,000 crores. The latest number that you see for July sees concentrated movement towards small and mid cap funds. Now, when you give this kind of a prognosis where you see slowing down of earnings in corporate India, do you think investors are in for an unpleasant surprise as far as the overall performance of mids and small caps are concerned over the next 12 months or so?
Shailendra, if you look at the past 3 to 3.5 years of mid and small cap stock performance, they have clearly outpaced large cap performance, and probably they've given in excess of 30% CAGR when you look at the index level. So clearly, this was backed by superior earnings growth as compared to large caps, and also the fact that at the COVID disruption, the valuations of mid and small caps were much lower than long-term large cap valuations, and also from a long-term perspective, they were much below the average valuations. So, given all of that, we have seen very, very strong returns in the last couple of years. So if any investor is looking at those past returns and expecting those to continue going forward, I think that's a misplaced assumption to begin with. If you are coming with slightly more moderate levels of return expectations, and also if you are comfortable with more volatility than what you have seen in the last couple of years, then I think there is money to be made in the markets. As we discussed, Indian growth story remains intact. The only thing is the valuations are expensive, and at the margin, there seems to be a little bit of slowing down of earnings growth. So to that extent, one needs to kind of moderate earnings expectations as well as return expectations from the market.
Okay. We've been showing the small cap and the mid cap returns on our screen, Harshaji. As far as the index level are concerned, about 64% increase in the small cap 50 index over the last 12 months or so. When you talk about moderating return expectations, what would you want investors to peg their hopes on over the next 3-year CAGR in mid caps and small caps?
Given the expectations of double-digit earnings growth and slightly elevated valuations at this point of time, I would say low double-digit kind of stock performance is a reasonable expectation. However, one will have to keep monitoring how earnings season goes every quarter hereafter, and also where the valuations are. But I think for a long-term investor, one could still expect probably low double-digit kind of returns from equities, given where our economy is and how our earnings growth are moving.
Okay. So this broad prognosis has been set in terms of what the second half of 2024 and subsequent 2 or 3 years would look at. Harshaji, we normally ask this question to all those people who have a deep insight into how the earnings momentum and their interlinkages with the indexes work. Given the fact that you now say that a 12% CAGR on Nifty set of stocks should be achievable, say till December 2025, where do you see the Nifty from current levels?
Shailendra, I would refrain from making targets or giving targets for the Nifty or market returns. But it's fair to assume that over the medium to long term, the market returns are dependent on the underlying earnings growth. And what we have seen over the last 3, 4 years, especially for mid and small caps, was a case where their earnings were growing in excess of 30%. And we also started with the very low valuations at the peak of COVID wave. So to that extent, their returns have been very, very strong over the 3.5 years. Going forward, we are expecting about, let's say, 12 to 14% kind of earnings growth for large caps and maybe slightly higher earnings growth, at least in the short term for mid and small caps. But valuation wise, while large caps are more or less around average levels when you look at the long term history, the mid and small cap valuations are much above that historical average. So, to that extent, it makes sense to expect slightly lower returns going forward from both these buckets. So, I would say low double digit kind of market returns if the current prognosis on the earnings growth continue should be a reasonable expectations. However, we will always need to keep monitoring this every earnings season and at every level of valuation.
Okay. Would you say, Harshaji, that the time of PE expansion on a broader market level in Indian stocks is more or less done with, and now we are looking at a mature PE, especially for maybe Nifty stocks, and from here on, only earnings momentum will determine the direction of the market?
That's a fair assessment to make, especially for mid and small cap basket, I would say. We have seen a fair bit of PE expansion or a valuation premium getting attached to Indian mid and small cap categories. So, to that extent, from here on, it would be crucial that earnings delivery happens. And depending on the earnings growth, one can expect a similar kind of returns from a medium to long term. However, on the Nifty or on the large caps, I would still say that probably there is still some room for valuation expansion as we are trading close to historical averages. In case of a very, very bullish argument, one can even talk about higher valuations than where we are today. So, to that extent, on the large cap side, not only there is a lot more visibility on the earnings growth levels, but also there is more comfort on valuation. So, I would say net, if you are making a portfolio with a slight tilt towards large caps, that would be beneficial both in terms of stability of the portfolio as well as overall returns.
Okay, now that we've set the overall macro and micro trend of the market, let's come to three funds, Harshaji, which you manage. Overall, Mr. Upadhyaya manages about 95,000 crore rupees in 7 Kotak funds. The biggest of them is the Kotak Flexicap Fund, which has about 53,700 crores. Coming in next is Kotak Equity Opportunity Fund, which was launched in September of 2004. It's given a 19% CAGR and has 25,000 crore rupees under assets management. And then there are two new funds that are looked after by Mr. Upadhyaya. There is the Kotak Quant Fund, launched somewhere in August of 2023, 1 year ago, and the return has been, hold your breath, 52% in the past 12 months. And of course, the Kotak Manufacturing Fund, launched in February 2022, given a return of 32% with assets of about 2,500 crore rupees. Broadly, Harshaji, when you see the allocation of equity in specific sectors in these 4 or 5 funds, where do you think you see maximum growth coming into earnings?
I think clearly the earnings visibility is much higher for domestic businesses even today. Given the fact that Indian economic growth has been continuing at, let's say, 6.5 to 7% GDP growth rate levels at least, and the fact that earnings growth has been in the low double digits or mid-teens, we would say that there is a reasonable upside that can come from domestic businesses in terms of the earnings growth. So the sectors which are closely linked to domestic economy are the ones which are likely to outpace some of the industries which are more export oriented or global facing, in our opinion. So our tilt in the portfolio still is towards domestic sectors, which anyways are expected to fare better than global facing sectors, given the fact that global growth continues to be a little questionable and sluggish at this point of time.
Okay, fair point. Let's just pay attention to Kotak FlexiCap, which is running right there in front of you. The CAGR return has been 15% since September 2009. While Harshaji, the fund has done phenomenally well. If you look at the last 1 year return, you've done somewhere like 37%. But as gently as possible, would you just want to defend Kotak FlexiCap's performance when we see it over the peer level? It hasn't been, how should I say, as salutary as some of your other peers have done. What would be the reason why, this kind of, how should I say, lesser relative performance that came in? And what can be done to sort of improve upon that? I'm sure you're doing it.
One of the issues that affected the fund performance in that period was the fact that we were a little more tilted towards large caps. As we spoke, we have a lot more valuation comfort on large caps as compared to mid and small caps. And we wanted to keep that tilt towards large caps. And in the past, however, it has not worked in our favor, as despite valuation concerns, mid and small caps have continued to move much higher in terms of overall performance as compared to large cap basket. But we do believe that for a long-term investor, just not returns, but also the volatility of the fund is equally important. And we would like to be in sectors and in categories where there is also valuation comfort along with earnings expectations. That's where we have tilted our portfolio towards large caps, and we have always been about 65 to 75% in large cap, and currently we are at about 72%. And we do believe that this is something that will work out over a cycle, as some of the expensive valuation categories also go into corrections at various points of time. We should see that performance coming back in a strong fashion, which you would have seen over the last 1 year as well with the returns.
Absolutely.
And on top of that, there has been a change in the benchmark as well, which happened towards end of 2021 as specified by the regulator. So the comparison that you are making is with the new benchmark, whereas for the entire period, that was not the benchmark. There was an earlier benchmark which was also there. So probably it's not apples to apples when you compare it to the new benchmark in terms of for last period performance.
Fair point. And I think if you continue holding your conviction, that is what matters. We have seen large caps sort of suffering on a relative basis compared with mids and smalls. And if you look at Kotak Equity Opportunities Fund, I think people and unit holders there are much happier with you. You are consistently in the upper quartile as far as 5-year, 7-year and 10-year returns are concerned. In fact, Kotak Equity Opportunity Fund is ranked 3rd on a 10-year basis. It's handsomely beaten the index by giving a CAGR of 17.6%. And out of 17 funds which have more than a 10-year history, Kotak Equity Opportunities Fund is 3rd on the peg. So that's a fantastic performance, Harshaji. Let's look at the portfolio on this fund and maybe look at how phenomenally overweight you are in industrials in this space, which has done phenomenally well, and underweight in financials. What's the story, Harsha, behind this industrial rally? You also have a specific manufacturing fund which you handle. How do you see this over a 5-7 year period when it comes to looking at the manufacturing space within corporate India?
Industrials is a subset of the overall manufacturing space that one can invest into. If you look at industrials, I think all the positives are coming together at this point of time. We do expect the investment cycle to revive. We are already seeing early cycle green shoots coming in. We have already seen large capacity announcements happening from public sector entities and government capex related entities. We also expect private capex to improve over the next couple of years. So the direct beneficiaries would be industrial companies, which will benefit from this kind of capital expenditure plan that we are going to see in our economy. And that's what we are playing in equity opportunities, where we have been overweight on this segment and it has delivered very, very strong returns in the past. Although the valuations, one could argue and probably see that it has moved up quite meaningfully in the recent times, based on which we have also partially booked some profits in some select names in industrials, which is an ongoing exercise that we will have in any fund. So that's what we see in terms of industries. As far as the manufacturing space is concerned, clearly it is more than just industrials. It could be any manufacturing activity in the country. And there is a lot more flexibility for the fund manager there to move from one manufacturing segment to another in case the fundamentals warrant or the valuations demand that. And that is also a theme which will play quite well over the next 5-7 years, in our opinion, because for the first time we are seeing that India is building capability not only to cater to its domestic demand but also the growing exports demand. And there is definitely a place for India in the global trade and commerce across many sectors, where our quality levels are superior, where our logistics also play a part, etc. So clearly, I think there is a long way for manufacturing as well as a theme.
Okay. Harsha, I'd just like to spend a little more time on the latest baby that Kotak AMC has launched, which is the Kotak Quant Fund, just a year old. From 10 rupees, the NAV has shot up to 15.46. That's a 1 year return of 52%, ladies and gentlemen. And not many people know that Mr. Upadhyaya is one of the original kings of running a very, very popular and a very profitable arbitrage desk that started at UTI AMC. And this business overall within the fund space has done phenomenally well. So 892 crore rupees in Kotak Quant Fund, Harshaji, 59 stocks, and you've given a return of 52% in the last 12 months. What's the magic and the secret recipe behind this?
Shailendra, this is a slightly a different theme, I would say. This is a fund where there is a combination of man and machine working. The fund invests based on a quantitative algorithm into a select set of stocks, which are chosen by the algorithm and in the proportion that it has been decided. So there is no intervention from the fund manager once the rebalancing happens, and the rebalancing happens once in 3 months. So we have set the boundaries in terms of how to pick and choose stocks, and based on which the machine throws a certain set of stocks and the weightages, and those are used for portfolio construction, and the same portfolio continues for next 3 months until the rebalancing. So this is one of the different ways of managing money. It's a quantitative technique that we use here. And yes, although it's a very short term, short tenure until now since the inception, the fund has done exceptionally well, I would say.
A couple of other questions on this particular technique, Harshaji. The stocks that I see are fairly normal ones in this. Let me just, for the benefit of our viewers, read out the first 5 or 7 names that come in front of me. Sun Pharmaceutical, from the auto ancillary space, Bosch, diversified company Grasim, pharmaceutical firm Zydus Life Sciences, India's largest bank SBI, the most profitable two-wheeler maker Bajaj Auto, TVS Motors, Interglobe Aviations. The names, Harshaji, are absolutely common to many other stocks and funds that are there. But is there a difference in how you run this fund? Are these very short term calls? Do you track momentum? What does the algorithm do?
Shailendra, you are right. The fund names will give you a lot of comfort because this is part of Kotak investment universe and the same set of stocks you will see in all our funds. What is different here, as I explained, the technique is a quantitative technique where an algorithm picks a certain stocks based on momentum factor. That's the primary factor. Generally, when you look at momentum, it's a double-edged sword. Sometimes, when the momentum breaks, there can be huge volatility in the fund. So we have also added a couple of other sleeves along with the primary sleeve of momentum to manage the fund. So we take care of quality and governance through our investment universe, which means that already there is a research view and our research team has worked on those particular businesses under coverage. We also look at volatility. So when we are assigning weights to the selected stocks, we take care of the volatility, and the lowest volatility stock from the selected universe will get the highest weightage in the portfolio. And thereafter, it starts going down in terms of the weightages. So we are kind of managing this fund based on three factors: momentum, quality, as well as volatility. That's how the algorithm has been created. And once in 3 months, we rebalance the portfolio. Some of the stocks may continue to remain in the portfolio. Some of the stocks may change in terms of the stock weight. Some may completely exit the portfolio. But we do not interfere in the rebalancing process. Rebalancing to rebalancing, whatever inflows and outflows come, we completely replicate the portfolio or completely cut the portfolio in the same proportion. Once in 3 months, whenever the rebalancing happens, there is a new portfolio that continues for the next 3 months. So that's the investment process as far as this fund is concerned.
Okay, that's both exciting and intriguing to learn. The turnover ratio for Kotak Quant Fund is in the vicinity of 138%, and that probably reflects the kind of work that this wonderful algorithm has been doing. A couple of final questions, Harsha ji. Anything that keeps you awake at night, given the fabulous Goldilocks kind of a scenario that we've seen in Indian equities over the last 25, 26 months? Any niggling pain that you might feel the markets may experience unknowingly and may correct sharply? Any black swan events that are on your radar?
Shailendra, black swan events are called black swan because of the definition, right? So at this point of time, fundamentally, when you look at the markets, there are not too many negatives that are in front of us. Yes, there is valuation risk. There is a little bit of momentum that's slowing on the earnings growth, etc. But no real large negatives in front of us. I think we will also have to watch out in terms of what happens in the global markets and global economy, because all said and done, while we may be insulated from a medium to long-term perspective in terms of how our economy behaves or how our markets behave, but in the very short term, the liquidity and the sentiments do drive markets. So to that extent, I think we need to keep a watch on global events as well. I would say valuation risk is probably the biggest risk at this point of time, especially for mid and small caps, not so much for large caps.
Okay, Harsha ji, thank you so much for this lovely 25-minute chat that we had with you. It's been a learning process trying to understand the algorithm behind the Kotak Quant Fund, and I'm sure it will continue to do extremely well. Thank you so much for your time, and I hope you make as much money for your unit holders as you've done in the past 20 years. Have a nice day, sir.
Thank you so much. Thank you.
That, ladies and gentlemen, was Mr. Harsha Upadhyaya. He is the Chief Investment Officer at Kotak Mahindra Asset Management Company. Runs 7 funds with a corpus of about 95,000 crore rupees and has done phenomenally well at Kotak Equity Opportunities Fund, the Kotak Quant Fund, and the Kotak Manufacturing Fund. Kotak Flexicap Fund has some issues, but he says that will be sorted out as people gravitate and move towards large caps in the coming 6 odd months. I hope you enjoyed this conversation as much as I did, but for the moment, let's pause it. News continues on the other side of this break on Business Today Television, and I'll be back at 2:30.
The candles have melted. The flowers have dried up. But cries for justice for Abhaya have not faded.